You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is February 10th, 2026. We are looking at Silvercorp Metals, specifically their third quarter of fiscal 26. And Miro, honestly, I feel like I need a flow chart just to figure out if they made money or lost money this time. It's one of those good news disguised as bad news quarters, isn't it?
Disguised is polite. It's an accounting hallucination. Look, the headline says they lost $15.8 million. The reality is they printed cash. So, just another Tuesday in the mining sector where GAAP accounting tries its best to confuse everyone.
Right. So before we pull out the calculator and ruin the magic trick, quick reminder to everyone that we're just two friends looking at numbers. This is definitely not financial advice, just our personal takes and occasional rants. So set the scene for us. Headline numbers. Why is the market confused?
Well, let's start with the top line, because that's real. Revenue came in at $126.1 million. That is a massive number for them. It's up 51% from last quarter, not year over year, quarter over quarter. Basically, they mined about the same amount of metal, maybe a little more, but they sold it at a king's ransom.
51% jump in 3 months? That's wild. And that's mostly the silver price running, right?
Entirely. Realized selling price was just under $49 an ounce. When you're selling silver for nearly $50, you can afford to be a little sloppy elsewhere. But here's the kick, Susie. GAAP net income, a loss of $15.8 million. But if you look at adjusted net income, which usually I hate, but here it's actually the truth, they made $47.9 million or 22 cents a share.
Okay, wait. So the official rules say they lost money. The logic says they made $48 million. Why the gap? Did they set a pile of cash on fire?
No. Paradoxically, they lost money on paper because their stock price went up. They have these convertible notes, right? When the stock rallies, and it rallied hard through the quarter, the value of that debt liability increases on the books. So they have to take a $60.2 million non-cash charge. It's basically a penalty for success. The better the stock does, the worse the GAAP earnings look.
That is profoundly counterintuitive. Like, sorry, shareholders, we're doing too well, so we have to report a loss?
Welcome to derivative accounting. But the market seems to get it. Or at least they aren't panicking.
Yeah, looking at the screens today, it was a bit of a roller coaster this morning, right? The stock had been on a tear, up something like 34% during the quarter, closing in on $11. Then this morning, earnings drop, it wobbles, dips to $10.50, and then just climbs back up, closed around $10.88. So investors are basically saying, we see your fake loss and we raise you a silver bull market.
Exactly. But I wouldn't get too comfortable just yet. The price action is masking some actual operational friction. It's easy to look like a genius when silver is $50. But if you look at the production costs, actually, no, wait. Did you see the cash cost per ounce line?
Oh, I did. I circled it 3 times. Negative $3.02. Negative $3. Miro, explain that to me like I'm 5. They are getting paid $3 to take the silver out of the ground?
In a way, yes. Because they mine lead and zinc, too. They sell those byproducts, use that cash to pay for the mining, and have $3 left over per ounce before they even sell the silver. It sounds amazing. It's a great cocktail party fact, but it's also a bit of a trap. It hides the fact that the actual rock they're digging up is getting lower grade. They're processing way more ore. Tonnage is up 23% to get just a little bit more silver.
The run faster to stay in the same place strategy.
Precisely. It's affectionately called shrinkage mining, which sounds like a medical condition, but
gross.
But it essentially means they are diluting their own ore. They're moving a lot of rock. So great revenue, confusing accounting, and beneath the surface, the mine itself is getting a little harder to work.
And that's the hook, right? Everyone's staring at the shiny silver price, but you're worried about the geology. Also, didn't they just wire almost $100 million to Kyrgyzstan?
Yeah, while everyone was watching the silver, they quietly decided to become a gold company in Central Asia. $92 million in cash gone out the door in January.
Okay, so we have a paper loss that's actually a profit, a negative cost that's actually masking dilution, and a pivot to gold that nobody's really talking about yet. This is messy, but interesting messy.
Messy but rich is the theme of the quarter.
All right, let's peel back the accounting layers then, and I want to know if that cash flow is real or if that's just accounting magic too. Let's get into the details.
Well, short answer, it's a bit of both. Long answer, look, they reported a record $133 million in operating cash flow, which sounds heroic, but about $44 million of that, roughly a third, came from a streaming deposit from Wheaton Precious Metals.
Oh, hold on. A streaming deposit, that's basically an upfront payment for metal they haven't mined yet, right?
Exactly. It's financing. It's debt-like. But on the cash flow statement, it sits right there next to the money they made actually selling silver today. So, did they generate cash? Yes. Was it all from operations? No. If you strip that Wheaton money out, the quarter is still solid, but it's not the record-shattering event the headline implies. It's engineered.
Engineered. You love that word today. So, okay, the bank account is full, but partly because they took a cash advance on future work. But what about the work itself? You mentioned this shrinkage mining thing earlier. It sounds like a Seinfeld reference, but I assume it's actually technical.
I wish it was a joke. It's actually a specific method they switched to at the Ying district. Here's the trade-off. Shrinkage mining lets you blast and move way more rock, and the numbers show it. Tonnage was up something like 24%. They are moving a mountain of ore. But the downside is dilution.
Dilution, as in you're scooping up more waste rock along with the silver?
Precisely. You're moving more tons, but the grade of that rock, the amount of silver per ton, drops. So you're stressing your mill, you're burning more energy, and you're wearing out your equipment just to get the same amount of metal. And this isn't just me nitpicking. They actually admitted on the call that this efficiency trade-off is biting them. There was this moment in the Q&A where an executive, I think the CFO, was asked about their full-year guidance.
Oh, I think I missed that part. What did they say? Usually with silver prices this high, they'd be raising guidance, right?
You'd think. Instead, he said, let me find the exact phrasing here. Yeah, he said, if we're looking at guidance, it would be at the lower end, and that might be still challenging at this point. Still challenging. That is corporate code for we are probably going to miss.
That's a stark contrast to the 51% revenue jump. So let me get this straight. Silver prices are essentially saving them from their own geology right now. They're mining lower grade rock, diluting it, and struggling to hit production targets. But because the market is paying $50 an ounce, nobody notices the engine is sputtering.
Sputtering might be harsh, but yes. The margin of safety is entirely provided by the market price. And don't forget the XRT sorter. That's the tech they use to sort waste from ore, was down for maintenance in October. So you have higher dilution, and the machine meant to fix dilution was turned off for a month. It's just physically, it was a hard quarter. Financially, it was a bonanza.
It's like running a marathon with a sprained ankle, but you're running downhill, so your time looks amazing.
That is actually a perfect analogy. But eventually the hill flattens out, or the price drops. And when that happens, you're just a guy with a sprained ankle, which I suspect is exactly why they're suddenly very interested in spending that cash pile outside of China.
Right, the pivot. Because if the Ying mine is getting harder to squeeze, you need a new growth story. And usually in this industry, you buy that story rather than build it.
Exactly. So where does this leave them heading into next quarter?
Right. So let's talk about that spending spree. You hinted at it earlier. They wired $92 million to Kyrgyzstan in January. That is not a small impulse buy.
No, that is a full strategic pivot. For years, this was the China silver stock. Clean, simple, focused. Now they have the El Domo project being built in Ecuador, and they are buying gold projects in Central Asia. They are aggressively diversifying away from being a one-mine pony.
Which, to be fair, makes sense if the pony, the Ying district, is starting to wheeze a bit with this dilution issue. But it changes the flavor of the investment, doesn't it? You're not just betting on silver price anymore. You're betting on their ability to build mines in 3 different countries.
Exactly. It introduces execution risk, lots of it. And it burns cash. That $460 million war chest looks huge now, but mine construction eats that up fast. So the question for investors shifts from how much cash do they print to can they actually build these things without blowing the budget?
The classic growth at what cost dilemma. So bring it home for us, Miro. We have Q4 coming up. What is the outlook? Are we expecting a victory lap or?
Warning signs. Definitely. Remember, Q4 includes the Chinese New Year. The mine shut down for 3 weeks in February. They rely on stockpiles during that time. If the ore grade stays low, like it was this quarter, and they lose production days, hitting even the bottom of that annual guidance is going to be tight. Management practically admitted it.
So Q3 was the high price saves the day quarter. Q4 might be the reality check.
I would bet on it. Unless silver goes to $60, the physics of the mine are going to be hard to hide next time. It feels like a transition period. They need the silver bull market to keep the lights on while they try to renovate the house.
Fair enough. It's like they're trying to switch cars while speeding down the highway.
That is optimistic, but accurate.
Well, that is my job, to find the poetry in the CapEx.
And mine is to complain about the suspension.
All right, let's leave it there for today. And that is where we're going to leave the analysis for this episode. But before we sign off, I want to take a brief moment to pull back the curtain on what you're actually listening to. Earnings Unscripted is an experiment. It is a project by a small team of enthusiasts trying to map the frontier of AI and how it can be used to enrich us rather than just replace us. This entire episode was created by a workflow of AI agents, from the research analyst parsing the 8Ks and transcripts, to the scriptwriter shaping the narrative, to a fact-checking QA specialist, and finally to the voices you are hearing right now. We are all working together to deliver high-quality, up-to-date information at a speed and depth that would be incredibly difficult otherwise. We are still learning, and we would honestly love to hear your feedback. What felt real? What felt off? And if this actually helped you understand the quarter better. You can reach us at earningsunscripted@datamadness.ca or follow the updates on X. Thanks for being part of the experiment.
See you after the next call.